This week's market recap starts with the Hormuz shock that hit oil and spread across everything else. We break down the stagflation warning from fresh PMIs, the hawkish reset in rate expectations, rising treasury yields, a firmer dollar, a deeper S&P pullback, and why Nvidia became the pressure point for the whole tape. Welcome back to the weekly market recap. Let us start with the shock that drove almost everything else. The biggest swing of the week came from the Iran war and the Strait of Hormuz, the narrow route that carries about one-fifth of global oil shipments. On March 23rd, Donald Trump said planned strikes on Iranian energy infrastructure would be postponed for 5 days. That headline hit like a release valve. Brent crude plunged about 15% to an intraday low near $96 a barrel, and WTI dropped about 13.5% to $85.28. Stocks loved it at first. The Dow jumped 631 points to 46,208, and the S&P 500 gained 1.15% as traders briefly priced in lower supply risk and less inflation pressure. But that calm did not last. Markets quickly realized that a delayed strike was not the same thing as a ceasefire or a safe reopening of the waterway. On March 26, Trump extended the pause again, this time by 10 days to April 6th, yet the second reprieve had much less calming power. By March 27th, Brent was back up 4.2% on the day at $112.57, and WTI had climbed 5.5% to $99.64. The message was clear: traders were still pricing a live supply threat. Higher crude also meant higher gasoline, freight, fertilizer, and broader input costs, so the oil move started feeding directly into inflation fears again. By the end of the week, that oil shock had spread across the whole market. The Dow fell 1.7% on March 27th to 45,166.64 and entered correction territory, meaning it had dropped 10% from its February 10th record high. The Nasdaq lost 2.1% to 20,948.36 and stayed in correction, while the S&P 500 dropped 1.7% to 6,368.85 and finished the week close to the same line. This became a full cross-asset repricing around one choke point, not just another war headline. And that set up the next problem for investors: growth data starting to flash a stagflation warning. After the Hormuz shock hit markets, the next punch came from the data. On March 24th, the first big March business surveys showed a nasty mix of weaker growth and hotter cost pressure across the developed world. That is the basic definition of a stagflation warning. The combined output index for the four largest developed economies fell to 51.2 from 52.2 in February. In the United States, the flash composite PMI slipped to 51.4 from 51.9, its lowest reading since April last year. In the euro area, the composite reading dropped to 50.5 from 51.9, a 10-month low. The details made the message worse. In the United States, service activity grew at its weakest pace in 11 months, and the survey implied annualized GDP growth of only about 1.0% in March and roughly 1.3% for the first quarter. In Europe, firms reported the fastest cost increase since February 2023. Germany showed an important split, with services slowing to 51.2 while manufacturing improved to 51.7, suggesting some factories were helped by front-loaded orders even as the broader economy softened. Supplier delivery times also lengthened sharply, pointing to fresh supply strains. Britain added to the same story. Its preliminary composite PMI fell to 51.0 from 53.7, the weakest in 6 months, while manufacturers reported an input cost index of 70.2 versus 56.0 in February, the biggest monthly leap since 1992. For markets, that was the real problem. The soft landing story was getting hit from both sides at once. And that is exactly why the next debate turned straight to interest rates. After the PMI shock, the next turn was all about rates. Central banks had just become less free to support growth. The Federal Reserve had held rates at 3.50% to 3.75% the week before, and most officials had still pointed to one quarter-point cut as the next likely move by year-end. But by March 26th, that mood had changed fast as officials focused on the inflation risk from higher energy prices. Lisa Cook said the balance of risks had shifted toward inflation. Philip Jefferson warned that sustained higher energy prices could worsen inflation and weaken spending. Michael Barr said policymakers needed to stay vigilant on inflation expectations, and Thomas Barkin argued that war uncertainty was a reason to stay steady, not rush into easing. Bond markets got the message. By March 27th, the 2-year Treasury yield was near 3.914%, and the 10-year yield was around 4.438%. The move spread well beyond Treasuries. By March 27th, the dollar index had climbed to 100.17, the yen had weakened to 160.35 per dollar, and Europe was also debating a more hawkish path even as growth risks worsened. That left markets with the worst mix, slowing activity, but less room for rate cuts. We start with SPY because the broad market is clearly in deeper pullback mode now. This chart marks a fresh 5% plus pullback low on Friday, March 27th, and the drawdown is now around 8.8% from the swing high. That is a clear worsening from the prior week, when the pullback was shallower and still looked more manageable. In plain English, the S&P 500 is no longer just wobbling inside a routine dip. It is trading like risk appetite has been reset lower across the whole tape. If the oil shock keeps feeding inflation fear and policy caution, this deeper pullback can stay the main reference point for equities. The tactical picture still leans bearish. SPY has now spent 8 sessions below its rising trend channel and sits about 5.3% under the lower boundary, while RSI is down at 28 and momentum is still weak. That is a notable deterioration from last week, when price was testing lower support, not living outside the structure. The key level to watch is the lower band near 669.81, because until SPY can reclaim that area, rebounds can run into resistance instead of turning into a real recovery. Zooming out, the long-term trend has not fully broken, but it is under real strain. The 50 days average is still above the 200 days, so the golden cross is technically still alive. Yet price is now about 4.2% below the 200 days average. That is a much weaker position than in the previous video, and it tells you the bullish structure is now fragile rather than comfortable. If macro stress eases, SPY can still repair some of this damage, but if crude keeps driving inflation pressure, the broad market stays vulnerable. And that leads straight into crude, because oil is the clearest outside force behind this reset. After the SPY sell-off, crude is where the macro shock becomes impossible to ignore. This chart shows ATR in the upper 99th percentile of the past year, while historical volatility has surged to 95.5%. In plain language, oil is not just moving. It is moving violently enough to reset inflation expectations and risk appetite across markets. That is a stronger stress signal than in the previous video, where crude was already elevated but not this extreme on the volatility side. If the Hormuz supply story stays live, this kind of volatility can keep forcing investors to price a tougher macro backdrop. The next chart shows why crude matters so much right here. Price is sitting only about 4.28% below resistance near under 5.51, RSI is up at 66.1 and rising, and crude is still above the 20 days, 50 days, and 200 days averages in a bullish stack. So buyers clearly still have control, but this upper zone is the decision point because a clean break would confirm more upside, while rejection could trigger a sharp pause. If war headlines keep reviving supply fears, this resistance test can quickly become the next inflation trigger for the whole market. Zooming out, the bigger message is that US crude is no longer acting like a brief spike inside a weak trend. The 50 days average has been above the 200 days for 16 days, which puts CL equals F in an early stage. Golden cross and points to a possible longer trend shift higher. The 200 days has only just started to stabilize, so this is still an early phase, not a fully mature uptrend. But if crude keeps holding this stronger structure, the bond market is likely to keep demanding more inflation premium. And that leads straight into the 10-year yield. After crude reset the inflation debate, the 10-year yield shows how fast the bond market is reacting. This chart puts TNX at a 7-month high in ATR, which tells you rate volatility is picking up again, not calming down. That matters because rising yield volatility usually means tighter financial conditions and less room for equity valuations to breathe. It is also a clear step up from the previous video where yields were firm, but this volatility signal was not yet this stretched. If oil stays elevated and central banks keep sounding cautious, rates can remain a live source of pressure across markets. The next chart shows just how far this repricing has already gone. Yield is sitting only about 0.5% below resistance near 4.46, with RSI at 66.8 and rising, while price holds above the 20 days, 50 days, and 200 days averages in a bullish stack. So momentum still favors higher yields. But this level is now the key decision point because repeated rejection can slow the move, while a clean close above resistance would confirm another leg higher. If the market keeps treating energy as an inflation problem instead of a growth scare, that breakout risk stays very real. Zooming out, the bigger message is that this is no longer just a short-term bounce in yields. The 50 days moving average has just crossed above the 200 days, creating a fresh golden cross and a new long-term bullish signal for TNX. In plain language, the bond market is starting to price a more durable shift higher in rates, not just a brief hawkish scare. If that stronger trend holds, the dollar has room to stay firm as well, and that leads straight into the next chapter, because tighter rates and a safer market tone are exactly the mix that can support the dollar. After yields repriced higher, the dollar starts to look like the next leg of the same macro story. This chart shows DXY breaking above its falling trend channel and trading about 0.5% beyond the upper boundary. Just as important, the upper band is now acting as support on the retest, which tells you buyers are defending the breakout instead of giving it back. RSI is at 61 and rising, so momentum is leaning bullish as well. If markets keep treating the oil shock as inflationary and risk-averse at the same time, this stronger dollar setup can keep tightening financial conditions. The momentum picture confirms that this is more than just a random bounce. MACD has crossed above its signal line, the histogram has turned positive, and price is already above a rising 50-days average. That combination usually means upside pressure is building, not fading. If the breakout holds and the market keeps dialing back rate cut hopes, the dollar has room to extend higher from here. Zooming out, the bigger message is that the old bearish dollar structure is losing control. The 50-days average is still below the 200 days, so the death cross technically remains in place, but price has already moved about 1.8% back above the 200-days average. That puts the longer-term bearish signal in a fragile state and raises the odds of a fuller trend reversal. In plain language, the dollar is no longer trading like a weak backdrop asset, and that leads straight into Nvidia, because a firmer dollar and firmer yields are exactly the mix that can pressure mega-cap growth. After the dollar strength chapter, Nvidia becomes the clearest test of whether growth leadership can still hold together. This chart marks a fresh 10% plus pullback low on Friday, March 27th, with the drawdown now around 14.3% from the swing high. That is a deeper correction than in the previous video, and it tells you the market is demanding a much lower price for AI leadership. In plain language, this is no longer a routine dip in a strong tape. It is a real risk-off repricing inside one of the most important leadership names. The tactical setup is now all about support near 167.52. Price is sitting almost exactly on that line, and the latest candle respected it, so a bounce can still develop while closes stay above support. But the rest of the chart remains weak, with price below the 20 days, below the 50 days, below the 200 days, and RSI down at 35.8 and still falling. If higher yields and tighter financial conditions keep pressing growth stocks, a break below this level remains the bearish trigger. Zooming out, the longer trend has not fully broken, but it is under real strain. The 50-days average is still above the 200 days and has been for 189 days, so the golden cross is technically still alive, yet price has already slipped about 6.5% below the 200-days average. That is a much weaker position than a normal pullback, and it raises the odds that the old bullish structure is failing. So Nvidia ends this recap as the pressure point that ties the whole week together, because when oil, yields, and the dollar all firm up at once, leadership gets much harder to defend. That is the real takeaway for March 23rd through 28th. The market is still trading around one core shock, with oil keeping inflation risk alive, yields and the dollar staying firm, and leadership looking much weaker than it did a week ago. If the energy story cools, risk assets can try to stabilize. But if supply fears stay live, this tougher macro mix can keep pressure on stocks and especially on growth. Thanks for watching. That was your weekly market recap for March 23rd through 28th. Stay sharp, manage the risk, and I will see you in the next one.